G'day everyone, Nick here from iFindProperty. Last night, Peter, Ambrose and I did something really fun. We got together on a group video call with a group of investors who've all started in property and have at least one investment and are looking to trying to figure out where to go from here. And it was really cool because everyone's in a completely different space, different ages, different work, different incomes, different strategies, different problems. And it was a really interesting conversation. To start with, we run through an introduction with everyone, and I'm saying this because we didn't actually record any lead into the video, so we just started talking. It's Trish who's introducing herself. She's just saying that she's in Masterton when the audio finally kicks in. But on the video, there is a young investor who's done really well and actually quit their jobs. That's Trish straight away. A former builder who's got a portfolio happening. A lady who's in her 50s and she's got great equity, both in her home and investment properties and some good cash flow, but wants more cash. Obviously, she's heading into retirement. She's got different requirements. There's a wine importer. He was popular. He's built up a portfolio quite quickly and is now sort of equity locked with the bank. Is trying to work out from there. Busy young mum with some really valuable property. Some have had problems and some really good unlocked sort of potential that could be unlocked. And there's another young guy in Auckland who's got some properties and wants to keep growing. So he's looking for income strategies, so ways to grow wealth, like with joint ventures and trades, and we talked to him about that. Just an idea of how the video works. First 6 or 7 minutes, we do a quick around the table introduction of everybody, and then we kick into about a 15 or 20 minute deep dive with each person, where they sort of talk through where they're at. Peter Ambrose is a financial advisor and a property coach. He was my property coach. So he's the main person giving the feedback. I chip in where I think I could add something, which is when Pete's on the call, there's not that often, but I've got a few bits to say here and there. And let's just see how this goes. So I'll sign off here, and it'll kick in straight as Trish is sort of halfway through a sentence, unfortunately. When I clicked the button, it didn't happen that fast, so don't be surprised when it sort of starts to jump straight to a sentence there. Hope you enjoy it.
I've been here for 4 years, and this is where I started buying property, and that's where all of the properties are that I own. 3 years ago anyway, there were very low house prices and pretty good return, and it still seems to be that way. So pretty happy here doing that. We do all our own renos at this stage, but I just quit my job when I got the keys to the last house, so the bank doesn't really like me anymore.
Oh.
Yeah, so that's our next, figuring out where we're at. But we've got quite a lot on the go that we can continue adding value to, but at some point in the future I will want to buy again. So I'm just looking at what sort of decisions I need to start making now to help for purchases in the future.
All right. I'm going to go. I've got a view of you guys, so I'm going to go around clockwise. That means you're next, Pete.
Oh, me. Hi, I'm Pete. Nick asked me to come and help on the webinar. I'm Peter Ambrose. I actually work contract to iFind as a property finder in Wellington. I'm a full-time property investor trader myself, and I'm a property coach and mentor. So I've number of students, mainly in New Zealand, one in Japan, and a couple in Australia and all parts of the country. I live in Wellington, and I'm a property finder, as I say, coach, mentor, and a full-time investor trader. And I've had a lot of properties, sold a lot, around 38 odd lease options, rent to owns as well, bit of trading. Commercial, I'm in the middle of doing a lot of renos. I've got about the next 3 years lined up with renos. Given where we are in the market, it's a great time to extend my properties that I already own. So looking at my own backyard and squeezing those out with greater than 10% yields for what I already own. So, yep, I'm here to help and throw some advice to some of you guys and see if we can help you along the way and with some different thoughts and just some ideas.
Sorry, Pete, I know I said I'd introduce you, but you did a better job of it.
I thought you wanted me to do it, right?
Yeah, no, I'll go next, and I'll sort of, before we move on, I'll sort of recap how we're going to run this. So I'm Nick. I spend half my time, 2/3 of my time in Japan, the rest of the time in New Zealand running iFindProperty. I have a Japanese, my wife is a business person over here. She runs a large music school. Been investing for a long time. Work with Pete. When I started investing in Wellington, had a really good experience and just completely tripled down on Wellington. And now basically every year or two, I buy an inner city property and renovate it to high cash flow and rent it out. And that's been a good strategy for me. And I'm just finishing up an absolute massive one, renovation, which has taken a lot longer and been a lot more expensive than I thought, but it's going to be good once it's done. And I'm looking forward to buying it myself. I co-run iFindProperty with Marie Tassel, and it's great having people of Pete's caliber in our team, and all of our team are investors. And the purpose of this call is, I thought it'd be interesting to get folks on who've been through our property course and who have made a start or invested, or in Trish's case, invested a lot and quit their job. But I've got a decision to come, like how do I do something new, or how do I expand, or I've got to this point, I'm not quite sure where to go, or some constraint has come in, or I'm concerned about where the market's at, or whatever it might be. And Pete's a property coach, and I talk to a lot of investors, and we could throw out some ideas and strategies that you might not have considered, or maybe just talk through the perceived risks and work out what actually are risks, and get some forward momentum for you guys. So that's me. And next on the list is, this is cool because you guys don't know who's coming, but it's Simon.
Is that me?
That's you.
Hey, how's it going? Yeah. I just got the email and I was quite interested to join in on the conversation. I'm quite a rookie, a newbie. Probably been investing only for two years now. I own my own property. Have good equity on that. My background is I'm a builder. I was a builder. I'm no longer a builder, but I have the skills required to be able to add value to properties, which I've been trying to do. Currently, we have our own property and 2.5 rental properties. When I married my wife, she already had a rental property with her brother, so that's the half. And then we just recently have gone unconditional on our second full property in Whangarei.
Is that where you're from?
You from Whangarei?
I'm from Auckland. We have half of a rental property in South Auckland, another one in Taupo, and the one that went unconditional is in Whangarei.
Awesome. All right, Ash, you're on the dock.
Cool. Okay. Hi, I'm Ash. I'm based between Wellington and Marston. Started about 2015, I think it was, beginning of 2015, late 2014. Bought two places really quickly, one within probably 2 months of each other. They're both now rented, and in the Wairarapa, one in Greytown, one in Marston. Kind of got stuck. This is the whole idea of the conversation when Nick put this idea up was, what do you want to know? And I said, right, I'm stuck with regards to lending. So equity has grown in those properties. Marston, the Wairarapa as a whole, has gone off with a big boom in the last 18 months to 24 months, really. So I've seen some good equity growth. My LVR is now fine. I've bought 1, 2, 3 properties this year. Sold one, did a quick reno and flip, and kept the other 2. One of which I'm about to move into to try and keep the banks happy for the next 6 months. But my big problem now is going into the whole idea of servicing the debt, where the banks are now getting itchy. I've got 4 properties basically, 3 rented out, 1's owner occupier, which I'm going to rent out within 6 months, get out of that and then look for another one. but the bank is just saying, I mean, I'm employed, earning money coming in, but they're just itchy about the servicing of the actual debt. So that's where I'm stuck. I'm looking at commercial property as well to try and change things around. The only way I can see a way through it is to buy and sell, and then buy and hold, and buy and sell, and then buy and hold. That seems to be in my mentality, and I'm a bit of a spreadsheet geek. It's all over the. Is that the only way I can do it is to buy, sell, buy, hold, buy, sell, buy, hold, and develop deposits through the buy and flip idea. So, yeah, that's where I'm at.
Okay, great, thanks. Hi, Lisa.
Oh, hi.
Hi there. Now, we can only see the top 2/3 of your face. There we go. Okay, sorted that one. So we're just doing a round of introductions, and then we're going to jump in and probably do a 10-minute deep dive on each person's situation.
Cool.
And just come up with some ideas for whatever happens to be in front of them. So next up, Rebecca.
Hi guys, I'm from Christchurch, born and bred, and don't own any investment property in Christchurch. We own our own home, but we've got 2 investment properties in Hamilton. And what else do I want to say? Oh, I've got the courage up to actually to buy a property investment here in Christchurch, which was a bit of an emotional, quite an emotional decision to get past that and actually put a deposit on an apartment in the Verve, which has since all gone. So it's
that was not good.
It happens, it's fine, but it's like very interesting for myself around the emotional, like what the work that had to be done and to come to terms with being okay about investing in Christchurch. It's felt as though having our home here has been a massive enough risk, given what we've kind of gone through. So yeah, anyway, so I'm kind of, that word stuck is a good word. Yeah, but I thought you were saying I'm going to come back and talk a bit more about that, so I won't hog any more time.
I'll just explain that the Verve. So the Verve is a development that was being sold off the plains, and essentially what happened was a developer sold their position to another developer who decided that they wanted to relook at all of the work that was done by the previous developer. They went radio silent for a long time, and then came back and said, no, we need to redesign absolutely everything, and we're changing it to be ultra premium and not investor focused. So everybody, thanks. And it just took a long time. But investors got their deposits back, and
with interest.
With interest, and so it wasn't financial collapse. I mean, that's all held in trust accounts, but it was definitely a crappy experience for everyone involved, including me. So we'll come back to you, Rebecca. Lisa, you're last up. Sorry, you've missed half of the hellos.
Yeah, sorry, just getting kids to bed. So I've got a home and income and 2 other houses here in Auckland, and I've got one up in Mangawai, and I'm just at the point where I bought the home and income a couple of years ago, but it's just been a bit of a hiccup. Like, we've been struck by both of those floods that have hit Auckland, and I'm just kind of a bit fed up with it's got a sort of a sub-basement, and we put heaps of drainage in, but I'm just a bit nervous about it happening again. So I'm kind of like, should we just get rid of that? When's a good time to get rid of it? How do I don't, I've never sold anything, so I don't even know where to go, or am I going to lose money on it? I probably bought at the peak, and so there's that kind of thing. But I'm kind of just emotionally fed up with that one. But the other and so one of the other ones, it's on a huge site, but it's basically a 2-bedroom, and It's got a big garage, and so I'm thinking, should I sell that other one I was talking about and just maybe do 3 new houses on that one? That would take all the, you know, I'd need that money, the financing from that to do that. So yeah, I'm kind of stuck as well as to knowing if that's a good thing to do. Should I hold on to the Mangawai one or get rid of that? It's not really a very good investment, but I always bought it kind of thinking we'd have a batch. But I mean, we've got the kids now, so we're just kind of snowed under and just don't have any time. So that's kind of gone out the door as well. So yeah, I'm just in a bit of a, yeah. But yeah, unknown position, not knowing what to do. So it'd be good to have your thoughts.
Sure. I've got kids. Pete's had kids. We can relate.
Yeah.
All right, brilliant, guys. So we'll rip into it. So put your hand up if you want to go first. Otherwise, I'm just going to have to grab someone.
Simon did.
Ash.
Oh, okay.
So was that Pete?
Sorry, Simon put his hand up first, I thought, but there you go.
Oh, did he? Okay, sorry, Ash, you're back
He's
at the
got a
TV.
close-up of your face, so you didn't quite see your head.
It's all right. I don't mind.
Go for it, Simon. So you're trying to figure out where to next?
Yeah. So, like I said, we've just bought our second full property, and yeah, just wondering about the market at the moment, and yeah, just wondering what should I do from here? Should I concentrate on? Well, I think what I've been thinking about is just trying to, because like I said, I have background in building. I like to do up or add value to the properties that I have at the moment, in the current, what I see as the market heading. But yeah, I'm just wondering. I thought I'd join in on the conversation and see what other people's thoughts were on where they think the market's heading, and which areas would probably be more beneficial. Because as I explained before, our properties, I'm from Auckland, but we've bought in outer regions, Taupo to the south, Whangarei to the north, trying to just diversify myself in that regards. So yeah.
Yeah. Hi, Simon. Peter. So I guess a question or something to think about for everyone while we go through it is just, what are the goals? What are you trying to achieve, as opposed to just investing from property going forward? It'd be good to know what you're hoping to get out of property, whether and what sort of time frame, because that sort of dictates the strategy you're likely to use. I think that as a general rule, I mean, the property, you know, where we are in the economic cycle, and the property cycle is probably part of that economic cycle. You know, it's still a little bit of growth, in my opinion, because it's, you know, supply and demand thing. We're still seeing more demand than there is supply at the moment. But be that as it may, I mean, when I look at property, I like to look at it as a flat market anyway. So on a rising market, you know, all your mistakes are going to succeed generally, because you know, over time. But if you do sort of your due diligence and your homework up front, then you know, should be able to succeed in any market. I think we are in South Auckland. I've had a few there as well. I haven't had any in Whangarei, but as a builder, you've got some advantages and you've got some disadvantages, as I'm sure you know. The Associated Persons Act is not your friend from a tainting perspective.
Ex-builder.
Ex-builder. LBP, or so were you an LBP, licensed building practitioner? Or?
No, I wasn't. No, I didn't quite. I left the industry just prior to that.
Right. Okay. All right. So we won't talk about tax and structures and anything today. That's a specialist area. But so I think, you know, is your portfolio sort of like producing any cash flow?
Yeah. So I'll try and answer some of the questions that you mentioned earlier. So yeah, my strategy is buy and hold. I don't really want to get too into trading. My strategy is very long term. My strategy hopefully will be to be able to retire early, prior to my 50s, and the properties will become what I can use as income in the future. So I want to hold them for a long term, longer than like forever, hopefully. yeah, so just keep building up the portfolio until I get a satisfactory income and be able to retire on that.
Right.
In terms of sorry, I was just getting to that. But oh yeah, sorry. The way that I have been looking, so in terms of that, the way I've been looking at the rentals, buying the property is cash flow. I don't consider capital gains at all because I don't intend to sell them, so it doesn't really factor in. So I buy in the areas that I see having good yields and a suitable rental base, and that's what I look for.
And I think that's a really good strategy. I think cash is always king, isn't it? And obviously helps with stability, but you might put some rules around where the number, populations, like they're not investing in cities under 20 or 30 or 40 or 50,000, whatever you come up just to preserve that whole single industry sort of bubble, but potentially. But I think that strategy is pretty solid. I think you can, enhance or speed things up if that's what you're looking to do.
Yeah.
I do like the way that you're looking to enhance the properties you already got. I think this is a great market to do that because of the equity growth you've had in your properties. You've got an opportunity is generally to go back and refinance and pull some money out to improve your properties, to improve your yields. So I think this is a good market to do that. And as the whole economic cycle plays out with what's happening in the government and all that other stuff you're hearing, you're going to be in a good position to take advantage of that going forward. So I think looking what's in your own backyard, what you're doing at the moment, is probably the best option of all, with a view of maximising your rents. I don't know what it's like where you are. I know in Wellington, we do everything on fixed term rents. Well, we can. Obviously, they're looking into changing that, but
yep.
Year to year, and January through the beginning of March is always our peak area. So we're always looking, when we're renovating, to have things ready for the peak area at the peak time. So we work back from that as a general rule. So how, what are we going to do? How long is it going to take? So when do we need to start? So everything's ready, and then as soon as you do that, it's a case of refinancing, if you can, to increase that revolving credit to get you ready to keep growing that revolving credit, so you can go buy your next one.
Yeah, I guess my question would be, so I bought in Taupo, the first one, because a friend of mine lived there, and he was like, the rental market here is so hot, and it was the best place that I thought I could put my money, because I couldn't buy in Auckland pretty much, and the yields there just didn't look attractive anyway. So I went to Taupo, and I thought I did quite well there. I bought a house that had meth contamination, and the owners wanted to get out of the market, so I got a great deal. And then just a couple of months after, this whole meth thing just blew over. So I ended up getting great equity out of that. So then my next place I was looking at is Whangarei, and I hadn't initially thought of it, but my sister had just moved there. So I had some good intelligence on the areas to go to, and that's what promoted me to go there. So I guess my question probably would be, am I starting to diversify myself too much? Should I start? I've started to think maybe I should concentrate on one area. What would your thoughts be on that?
It's a good question, and I don't know if there's a right or wrong answer here. I think you're quite young. I don't have a problem diversifying.
I'm 32, by the way.
Okay, I'm 58, so gotcha. I don't have a problem diversifying around the country. You become so reliant on property managers, and they're the ones that really, that to me is more the bottleneck about getting into bed or a relationship with a great property manager. Your property's only as good as the manager, really, when you're away from town. For capital growth over a long period of time, obviously Auckland and the South Auckland's where to be, and all your other ones, being a positive yield can help, support that going forward. I probably wouldn't scatter myself everywhere, but major or main centres, Taupo is probably not a main centre, but I think you brought up a good point just before. Like, for all of us as property investors, what we are is we're problem solvers, aren't we, really? we find problems, we fix them, and we make money from fixing them through equity or even through rent. You found a meth contaminated, you had the knowledge, the gumption, and the skills to be able to get over that, and you've done well out of it. Now that could be Taupo, it could be Auckland, could be anywhere. But and everyone here on the call's probably got a similar story where they found something that was distressed, they added value to it, and now it was one of their best investments. So that's probably the formula. Where you do that probably doesn't matter, in my opinion. I'm saying that now I'm at my age, I've sort of sold all my other properties, and I've got mainly in Wellington because I can control them a lot better. So I'd rather have less properties, higher value, less tenants, is where I am at the moment, as opposed to having 50 properties.
Yeah, I guess my constraint is I think if I wanted to, and like I've been buying a house a year at the moment. If I wanted to, I could do that next year because my partner and I, our income is quite good, and our equity is very good in our own occupied house. So I could, if I wanted to, continue. But yeah, I was just wondering if however, I'm constrained by the amount that I'm able to be lended. I just can't do anything in main cities.
Okay.
Yeah.
I have an idea. I think just you're the fact that you're a builder, and the fact that you're comfortable in these areas means that just start to look for a bigger problem to solve, potentially. So you set the bar a little bit higher. You're obviously a little bit ambivalent about whether you buy next year or not. So say, okay, I'll move on a cracking deal that I could really get some great cash flow, really get some good equity, and I might need to roll up my sleeves and either project manage or do some work and something on this to make it happen. Otherwise, just happy to keep working on my own properties, let the rents grow, and build that base a little bit more.
Yeah, I think that's a good advice, Nick, as well. I think, I often say I'd rather have a $1 million property at 6.5%, 7% yield than a $400,000 property at 8% yield any day of the week, personally.
Okay.
And that's mainly around rates and insurance. I guess if you look at the number of weeks of rent it takes to pay off the rates and insurance, at a $400,000 or $500,000 property, it could be 10.
Yeah.
$1 million property, it might only be 2. So you're less susceptible to those standard increases as well. So yeah, I think that's good advice, Nick. I mean, the bigger the problem, potentially the bigger reward if you've done your homework and your risk analysis correctly.
Yeah.
Simon, we're going to have to jump on to the next person in a second, mate, but I'll leave you a bit of homework on our website, and if you Google it, it's an article that Pete wrote called
Due diligence?
No. What's the one you wrote about?
Balanced portfolio?
Yes, that's it. So memorable, I forgot the name. Balanced portfolio strategy. iFindProperty. If you Google it, it'll come up, and it's all about basically having, over time, building up a core of really valuable assets, and everything you do in the meantime, whether you buy to sell, you have cash flow properties, what have you, is towards that end goal. And I think with the amount of time you've got available to you in the next 15, 20 years, this could be really interesting for you to start to think about.
Thanks.
All right, Ash, you're next. I've muted you before, mate, because the chocolates were rustling. Yeah, you're right.
Yeah, no. I sell wine. I'm a chocoholic, so I apologise.
Oh, I like wine.
For the bed.
Oh, hang on. Thursday night, we'll meet you half an hour before we meet the others.
Yeah, no, good.
Thursday night, I'll see you then too.
I'll be there. So my scenario is quite different to Simon's. I don't have that 32-year-old age on my side. I'm 48. I want to be done and dusted in. I'd like to say 55, but possibly 60 is probably more realistic. As I said, I've got 4 properties now. One of them I've been renting right the way up until now. Kind of started this in 2014 when I came back from overseas. So I bought my first 2 properties really fast in the Wairarapa, and they've built and grown quite nicely. And then this year I've bought 3 more. One was a quick do-up job, and sold that. The other one I bought at exactly the same time, so I had 2 on the go at the same time. Again, value added, spent a quick 15 grand, improved the rent from 230 a week to 330 a week. And I'm just about to finish one on Saturday, which will be, I'm going to live in for 6 months and then probably rent that out and then look for something else. But that'll be, again, was 230, 250 a week, and I'll probably go for 330, 340 a week on a rental in about 6 months' time. My equity is okay, not too bad at all. LVR is good, so I've got money there to borrow once I get the houses revalued. But my issue is servicing. The bank is looking at it going, okay, you got 4 properties. Just a quick scenario is of probably about 150 million in value. I've got a mortgage of about 700,000, and the bank's just looking at it, just going, okay, your earnings in comparison to your mortgage is sitting very well, not quite enough for that 33 to 35%, depending on what they work with, taking in. I know I work out my calculations on, I'm with Westpac for my sins. Yeah, shoot me in the foot now, I know. God almighty. Don't worry, I'm trying to move. But I'm working that out.
I thought I was on mute, but you're like, God.
No, you're not. So I worked that out. I take my rent as an 80% of my income. I've got to say my personal banker is absolutely shite. I can't, so I'm looking to move there, but I am stuck. And I've gone to TSB and I've gone to ANZ and I've used the mortgage broker, and they're all coming back with a similar thing, is that your earnings are not going to justify buying another $200,000 to $250,000, $300,000 house. And that's where we're sitting in Marston at the moment, around about the $250,000, $350,000 mark. So yeah, I'm just all up for doing the work, totally into the value added, and that's what I've done with the last 3 places, is to add value. But yeah, just a bit stuck.
So are all your properties, Ash, are they in Masterton?
3 in Masterton, 1 in Greytown, but all in the Wairarapa.
So when you say I want to be done and dusted, what the hell does that mean? What does done and dusted mean?
I want to be living off the income from my passive income.
Right.
Drinking wine and not selling it.
Okay.
Definitely, yeah. Or even part-time, but yeah.
Part-time drinking.
Ideally, I'm going to have a house in the south of France and a house over here. So that's all
right. Yeah, you are quite high on the LVR. I can tell that. I was trying to work out why, because you've been adding value to these properties. And have you had them revalued? It's about 1.1 mil.
Not with registered valuations. I'm guessing they're somewhere between 1.1 and 1.3. I always err right on the conservative side. So
yeah, there's the serviceability. If you just talk about serviceability, I mean, first of all, you've got the equity. I think they'll probably value more than that.
Yeah.
From what I can gather, I'm talking with Trish before, but the serviceability is the issue, and Westpac are not the friendliest bank on serviceability. How are you going to improve that? Well, in no particular order.
Go to a different bank.
There are. I mean, they use different serviceability models. Obviously, all the banks, they're all different. Westpac is the least friendly of them all. I know ANZ's about 7.5 across the board, but there are banks like TSB.
Sorry, can I stop you there? When you said 7.5, what do you mean?
Right. So the way the banks, they won't tell you this, obviously, because a lot of them don't know. They put numbers into a spreadsheet and it says yes or no. So just briefly, what they do is they'll, this is a very high level and there's detail behind this, but at a high level, they'll take 40% of your gross salary.
40%? 40%
of your gross salary, excluding bonuses and all that stuff.
Yeah.
They'll take 75% of your gross rent. They'll add that together, and that's your serviceability. Then they'll look at what you have to service. So then they'll look at credit card limits. So quite often, if you're on the border, you can get a mortgage approved just by reducing your credit card limit for a period of time. They'll look at hire purchases, student loans, anything like that, all commitments you have for debt, child maintenance, care, all that stuff. And then they'll look at all the mortgages that you've got and applying for, and apply the serviceability rate With Westpac, I think it's 7.95. Principal and interest, even though you might be on interest only at 4%,
Yep.
they'll apply 7.95 servicing factor for 25 years on your total mortgage. And then they add all that up and they'll tell you whether, you'll know that if that number's bigger than your income serviceability, then the answer is no. And pretty much that's as simple as how you get a yes or a no.
Yep.
So you've got to change one of those two levers.
Yeah.
That's all you can do. You've only got those levers. So one is increase income, and the other is reduce debt. So reducing debt, like, as I said, credit cards, or changing LVR factors, serviceability rates by going to different banks, like, as I say, SBS, TSB, other banks like that we use down in the 5s. That makes a big difference. And keeping below 65% LVR, obviously, is pretty important. And
yep.
That's how they work it out. How are you going to get ahead? A couple of things. I guess you could potentially look at JV partners to do some trading, to help build up some lump sum money. And that could be, as long as you've got two different skills. One's potentially one's a finance person and the other's the finder and the project manager and stuff like that. So I wouldn't do that for a buy and hold, but I'd certainly do it for like a trade or a commercial or even a lease option, to try and get some more money to reduce that revolving credit, so you can become your self-funding, if you like. It's also income. You might find a bigger project that's going to get you over the line through, increasing value, like we're just talking before with Simon about increasing value on a bigger type project, which means you may have to leverage off what you've got or even sell even with a bid. Not that we want to do that, because
I did do that once.
Yeah.
I'll chip in. It's obviously not good because you put time into a property and all that and built and what have you. But I've done that. I sold a property. I sold it in Rotorua for a couple of reasons. One is I wasn't going to really invest in Rotorua again, but the other one was that pulled out a whole bunch of equity then and freed up debt that I could redeploy into something that I was confident I could build more momentum with.
Yeah. The only risk there, and as we were both just talking about there, Nash, but the only risk there is that if you're above 65% with that bank, they won't release all the funds of the so just be careful of that.
I did find that out when I sold the property, but it only took about 10,000 out of the pot, but that's worth checking. If that is the case, there is a strategy with brokers where you can refinance like for like out to other banks and then sell. So there's tactics. If you do get down that path, don't just put it up and sell it. Yeah.
I'd say with my LVR, I'm probably round about the 56%. Adding it all up, seeing I know what my mortgages are. Registered valuations, okay, they're going to, there's a bit of fluctuation there, but I'd say I'm pretty much around about 56%, but it is really just that servicing that's causing the issue. I don't want to sell one bit, because I think the properties I've got are all really quite solid. I'm sitting on a gross yield of about 8.8 to 8.9% across the portfolio, probably about 7.7% net. So I think that what I've got is quite solid. Bit of a mix between, there's houses there that are sitting on a large plot of land which I bought, which are quite subdividable, quite easily subdividable, future down the track. There's other ones that are just great cash cows. So it's just, I want to I'm
going to touch on that next, actually, with you, Ash. It sounded like you're increasing the value, but I was just wondering, want to question whether you're getting the maximum value you can out of your assets you've got. And that can include not so much subdividing, but sticking second dwelling on, or potentially subdividing down the track. But increasing the rents. So obviously, if you're at market rent, you can't. But adding any value you can add to your existing portfolio to increase your rent to help that serviceability.
I'd say I'm definitely at market value. I wouldn't be pushing it any higher. Two of the properties have gone up in the last 6 weeks to where they should be. The other one's pretty much right up there. So with regards to adding value and increasing the rent, I can't do that because I've rented out of the 4 properties. they've all been renovated in the last 2.5 years, to the tune of $15,000 to $35,000 per property. So they're, they are schmick. They're happy days. I'm probably not going to have to touch them for 10 years. So that's why I'm stuck, because I can't add any more value to the 4 that I've got. I'd say I'm pretty much at market rent on what I've got. So it's just the bank's not.
How much access have you got to cash? You don't have to answer that, of course, but have you got enough money to go do something with it?
Fuck all, Pete.
Okay, so not much.
No. Spade to spade.
Right, because you've spent the money on doing the renos, I suppose, and then you haven't been able to revalue since then.
Yeah, I mean, I'd definitely say my first mistake, probably with all bloody initial property investors, were I put too much into the first 2 properties. I had a bit of cash from a divorce, and I put in a full 20% into each property. So I probably chucked in about 120 grand overall into those 2 properties.
Yeah.
And that's now sitting in those. So those first 2 properties have got plenty of equity, but I don't have access to that cash to do it. So to try and move forward, that's why I'm stuck.
Are you? I mean, what would be of interest? Would doing some trades? Let's assume we can solve the money problem.
Yeah, no, totally. I mean, like I said right initially at the beginning, my workings out are that I need to buy and trade, and then do a buy and hold. So I did this year. I bought 2 properties. One was a buy and hold. One was a buy and sell. I sold it, done, made myself a quick, I think I did about 40 grand on it. And a pretty shitty, Trish will be sitting there just going, you bastard. 40 in quite a shitty area. And that set me up for the next one, which is now a buy and hold, and that's good. But now I want to do a buy and trade again. And I'm just thinking the bank's not going to go there. So, but it's the whole thing being painted as well.
There are other lenders though, Ash. If a deal's really good, there are other lenders.
Yeah, no, honestly, I've gone to a mortgage broker. I've spoken to a couple of brokers, and they tried to get me through TSB and whatever. I mean, my timing might be a little bit off. I'm not a patient person. I like to go at it all guns blazing, and I want to try and do 4 properties this year if I can. But yeah, I don't know. It just seems to me I don't want to get into that situation of I'm completely stuck. So I'm trying to plan 2 houses ahead.
So just breaking it down, could you go and change your finance line so you've got to turn it, so you've got a revolving credit, so your cash pool was bigger? Just do that.
Could I? Don't know.
Because then you can talk to places like Resimac and other outfits who are a 20% deposit.
Right.
Yeah, but you have to have your own house with Resimac. That's the only downfall. But and that's where we're going down that path about building up that revolving credit, so you don't have to go to the bank. I think just one thing. I know you said I want to buy 4 houses this year. It's probably irrelevant how many houses you buy. What's probably important is setting a goal of finance. How much where you want to be at the end of the year financially. That's probably more important than the number of houses. So don't get hung up on houses. The numbers are relevant. It's the outcome that's important.
Yep. That's very cool. Yep. Okay.
Yeah, I think refinancing or taking a good look at what you've got from an LVR, and you might not have the right broker. I know you've been to a few, but if you find a deal that's good, you'll get finance.
Yeah. I mean,
you might have to pay for it, but you'll get it.
Yeah, okay. I mean, there are plenty of deals in the master market, as Trish will let you know. I mean, they at the moment, that market is still quite hot. It's very regional. We are still piggybacking. We're probably one of the last regions to piggyback off everything that's gone on in the last 3 to 5 years.
Yeah.
It's going to fall on its, when it falls on its ass, don't know. But definitely want the buy and hold, getting the passive income coming through. But the only way I can see myself do it is to buy flip. And it's just, then I'm a bit nervous about the tainting because I don't know a huge amount about it. But the properties I've got that I'm going to hold on to, I'm going to hold on to. So I'm looking at, okay, well, if I get tainted and I sell 3 houses in 2 years, you know.
Are those houses, sorry, those houses you got them on principal and interest or interest only?
I've got 2 on interest only, 1 on principal and interest.
Okay. It may be you just probably need to stop where you are and obviously keep those houses because they're good houses. I'm not saying sell them. Do a JV, get a trade, show some cash to the bank to help the serviceability model. They will actually look at it, or they should do, because you already have a job, so you've got income coming in from other sources. And it may well be that be the kickstart you need. So finding the deal could be your specialisation and project managing, and you could be after just someone who's time poor, got no money, or got the money but no time. And you trust you, and you, obviously with a JV agreement, of course.
Yeah.
And go from there just to help kickstart it, and then maybe the next buy and hold you look for, your 8% yields aren't good enough. Maybe you have to go higher.
Maybe you do 2 trades. That's
Maybe
the other
do
thing.
2 trades.
Yeah, that's the other one. Do concentrate more on the trades for the next.
Well, trading's not going to build your long-term wealth. Your buy and holds will. So I really like
exactly. Yeah, that's what I mean. I'm like, I want the buy and holds, but I've got to do the trades, and there's shitloads more effort goes into a trade because you're selling, you're doing it to a higher spec, and then you sell it and you go, oh crap, okay, so I've made myself 40 grand, but I haven't made myself long-term wealth, have I? Correct.
So that's the buy and hold, and and the balanced portfolio article that I wrote and alluded to was all about creating, buy and hold is where the ultimate wealth is, and the rest is supporting the buy and hold. So as a strategy, and so have a read of that too, because it covers off what we're talking about in that article as well.
Okay, cool.
All right, we're going to have to push on in a second, but I'll flick you an introduction to a broker who I think might be interesting for you to chat with.
All right, thanks, Nick.
I just have the hunch that within all the equity and what you've built up, and there's an avenue for you to refinance something away, get up some revolving credit. So you take a house and some security and extra equity over to a bank, and then
I get that feeling as well.
Yeah, but without going through it line by line, which a broker can.
Yep.
There's no point. Okay then. So we're moving on. Trish, I'll take you off mute, Trish.
Cool.
Okay.
Thank you. Hi. All right. So we're a bit of a tricky one. We are completely buy and hold, and all in Masterton, and we kind of just got to a place we do all our own renos for very low cost. So we'll refurbish whatever is there or whatever we've pulled out of a previous rental. And so we got the keys to our last property in March, and we've just rented that one out. And in doing, as soon as I got the keys for that house, I quit my job. So that was, our main goal was to be able to be our own bosses. We didn't want to have bosses anymore. My partner has been working on renovations for about 1.5 years now. And then I just joined him again in March. So we're kind of at that place where we wanted to be, but now we're limited with future plans. We're happy where we are, and there is a little bit of value that we can add at the moment to what we already have, which is what we're currently doing. But we want to be able to enjoy projects in the future. So we're looking at what do we need to do now to set ourselves up for the next couple of years so that we can keep buying, because I'm very involved in the property market over here at the moment, and there's always deals coming up and there's heaps of exciting opportunities, so we want to be able to take on things, but at the moment the banks are just not interested.
So are these buy and holds, Trish, or buy and trades?
All buy and holds. Yeah,
all buy and holds.
Yeah.
Right. And you and so again, it's a bit of a serviceability issue.
Yeah, totally about serviceability, and we do know that we could go out there and get jobs just to I think maybe the best thing is to be able to get a job to allow us to get revolving credit, which unfortunately I didn't do before I left my job. So maybe that's the key, but if there are other ways that don't involve me having to go and have a 9 to 5, would be nice. So yeah, we're just working
that
around
probably was a mistake not getting that revolving line of credit before you
that.
left.
Yeah.
Big mistake. Yeah, I mean, it's similar, to be honest, to Ash as well, I think. I think given what you've done and your skills, it may be an opportunity to get some income through project management for other people as well, and expanding, because you love property. I hear it. I know you do. So maybe it's a case of getting some income from other property type ventures, whether it be project management or
How many of those do you think you would have to do before the bank takes you seriously as that being your job?
Well, the answer to that, it all depends on where the serviceability model is and how far behind on a monthly basis they're deeming you to be.
Yeah.
It's based on the formula that we were talking about before. So I can't answer that question from a number value, but you probably could, based on what I said before, and go do your own numbers.
Yeah, I have talked to a mortgage broker, and we've got plenty of equity, but I think we were sort of like $100 a week under what we needed to cover what we currently have. So we're working on that, but then to be able to figure out how we keep buying is the next one.
Same question, are they principal and interest or interest only or a mixture?
Principal and interest this year.
Right.
No, sorry, interest only this year.
Oh, interest only.
Sorry,
right.
yeah, just for this year we've got interest only, yeah.
Yeah, which helps you while you don't have a job, obviously.
Yeah.
Always the one. Again, I'm assuming you've maximised your rents that you possibly can, or you maximise the properties that you own to get as much off the land as you can.
Yeah, we're working on that at the moment. We've some that we're renovating, but out of what we've got, we've probably only got one that we could really look at adding a minor dwelling on, and that's not something I've done before, so definitely open to that and interested in hearing what people's thoughts are on doing that.
Yeah, I'm all for it. Whether it's a minor dwelling or it's a subdivision, or whether it's selling the sizzle, not the sausage. So it's quite often easier to do that. But I'm more of a fan of putting a property on the section and renting it out, because the return is over 10%, certainly over 10%. If you could do it, that is. What I have found in the past. Sometimes I've seen people that have picked up properties, moved it to the back of the section so they can build on the front. You've got to be really careful. That's not that often, particularly I would imagine a Marston, that would be that profitable. It costs quite a lot of money to pick up and move the house, relatively speaking, and then redecorate. So if you can get access to that piece of dirt, it's advantageous. But again, you're in a situation where you've got to maximise what you currently got.
Okay.
Not getting a line of credit was a little bit of an issue. But yeah, for you, you could certainly look at other property-related industries and add value to show an income outside just your buy and holds.
And would you just have to show that for 3 months, or would the bank want?
That's a different question, because you're starting a business. Often banks want to see a financial return.
2 years. Quite often they've asked for 2 years, but depends on the relationship you got with the bank, actually. I had a similar thing when I left my corporate job about 5 years ago. They, I think the first year, they were comfortable with, this is ANZ, with what I was doing in my business plan, and I didn't need to see 2 years worth of income. So it's about the relationship. But as a general rule, they like to, if you're self-employed, they like to look at 2 years. Absolutely.
Yeah, we are self-employed in that we have an accommodation business that we run from our place.
Right.
So that income does go towards helping with serviceability, but it's not at the stage where it would allow for another property at this stage. So maybe a joint venture is also a good idea. When you're talking about the minor dwellings, though, would you recommend, like, this would be a property that couldn't be subdivided? Would you just put in a 1-bedroom flat or a 2-bedroom, or try and do a 3-bedroom house? Oh,
look, that's a purely economic answer. Marston, what's the demand? Where's the sweet spot based on the rent? Because there's always a sweet spot somewhere where there's 2, 3, or 4-bedroom properties. I don't know. It just comes down to yield. One of the rules that I teach and I look at, and Nick will know it well, is that once you've got your property up and running, and you're thinking about doing something like this, renovation or adding another dwelling, or extending what you've got, I have a rule that says, like, for every $10,000 you spend, you must get at least $20 a week rent, increase in rent. Okay.
Yeah.
So you can apply that, like, for every 100,000 you spend, you must get at least $200 a week rent, and effectively that's about a 10.4% gross yield.
That's how much? Sorry.
It's about 10%, 10.4% gross yield. But it's better than that because you're already paying the rates of insurance out of the existing property. And the way that works, just briefly, or quickly, hopefully you can work it out in your heads. But if you've borrowed $10,000, right, and interest rate's 5.2%, it's $520 per annum to service that debt, which is $10 a week. If you're getting $20 a week in rent, see where I'm going with this? You're doubling your costs.
Yeah.
You're paying 10, you're getting 20.
Yeah.
It's a really good formula, and it's something that when you look at your budgets and you know, shan't I do this? Shall I increase add another bedroom? How much extra rent will you get? So classic is, I'm going to update the kitchen. The kitchen's old. If you're going to spend 10 grand, is it going to increase the rent by $20? If yes, then go for it. Because what that does, of course, is it increases the value of your property, so then you can go borrow more than that $10,000 you just put in.
Yeah.
That's a rule that I apply to all my renovations once it's all done and dusted and it's a going concern. Same with you, Ash, as well. That's a rule that I would apply for all your properties going forward.
That's a great tip.
Yeah, I like that.
Cheers.
First, couple of ideas. One, I quit my job without much of a plan when I was 31, having bought some properties, and stumbled and did joint ventures and stumbled around. And then I found myself in iFindProperty, and I bought into the business. The interesting thing was that I became a business owner very quickly. However, the banks didn't need for me to then do 2 years of whatever. But if I had then put if I'd put a shingle out on the street and said Nick, property finding industry, I would have gone through that whole 2-3 years rigmarole. So there might be a way that you can partner with an existing company, keep most of the revenue that you produce, since this is a strategy to just show income, and the banks can see that the business is established, the income is coming in, etc., and tick off the box without actually having to go get an office job. Because what they look at when they look at are you employed is they go and check the employer to make sure it's a legitimate thing. So that might be something worth checking out.
Okay, cool. Thank you.
No problem. Other than that, I mean, one soundbite that I got from a friend who's also a coach in Auckland, he said he calls it the P and the I. Instead of principal and interest, it's your property and your income. So you have a property strategy, which is what you're growing, and you have your income strategy, which you grow separate from your business. So for most people, their income strategy is the job. You don't have a job, so your income strategy needs to be something else, and you just need to think of it tactically like that. I think my income strategy, separate from my properties at the moment, is iFindProperty business. In the past, it's been some consulting work I did, and that's another one. Like I did some contracting, some project management with an office, and just went to the bank and said, I've got this income, and they said, great, you can go and buy whatever it is I was looking at there.
Yeah, because we've got our accommodation business, but I don't think it's ever really going to grow to the point where it's going to be 100% covering all the serviceability that we need. But I guess we just need to be able to do that one more. And that's where I have also thought about second tier lenders and what the possibility would be to borrow a small amount, or to borrow the amount of money that we need to be able to do the reno, to get somebody in there and rent it out, and then go to a bank and say, hey, we've got this property in our name, would you take it on?
Yeah, I've certainly done that. It's a good strategy. Obviously, it's a little risky because the answer could be no.
Yeah.
Short-term lending is generally 6 months, or can get a year, but you pay for it. And then quite often it's certainly easier once you own a property to get it refinanced than it is to get approval from the bank to purchase it. Absolutely.
Yeah.
It's a
But
valid
yeah, then you're just screwed if they say no.
yes. So you need, again, it's about knowing the outcome before you're going into the project. It's doing all the numbers.
Yeah.
Yep, absolutely. Yeah.
You can always sell it. So
Yeah.
you can hedge your bets by buying something that's not too quirky, and you know, nobody ever got stuck with a 3-bedroom block box standard house in a standard section for too long.
Yeah.
That is very, very true, Nick. You're absolutely right. The where we are in the so-called property cycle is quirky's not selling anymore. Quirky sells once every 10 years, or whatever the cycle is, the economic cycle. But they're not selling anymore. We're seeing property, the market in Wellington continues to go up. I don't know, my crystal ball certainly no better than anyone else's on the call. Probably see it for another year potentially. But quirky's starting to not sell. Some tenders aren't getting any offers in. Some of the funky stuff is not good. So the closest you get to the standard 3-bedroom picket fence weatherboard home, the more marketable it is if you get stuck with it. Yes.
Cool. Okay, some good food for thought.
Right. Okay. So who's next on this? Must be Rebecca's turn. You've been so patient. Oh, you're on mute still. Hang on before you tell us your life story. Have I unmuted you? Or I might have muted you again. Wait. You're staying on mute. Can you click the unmute button?
Yes.
There you go. There we are.
Great, thanks. Yeah, some great thinking and stuff. Just listening to other people. So thanks for sharing, because it's not that easy to share your own stories and stuff. It's a little bit vulnerable, but yeah. So our story is that we've got 2 rental investments in properties in Hamilton. They've both done really well from a capital gains perspective. And between the 2 properties, we are generating good cash flow. So really happy with those. That took quite a while. One we bought in 2010 and one we bought in 2015, and we bought both of those new. Our situation is that we have really good income, no dependents, family home, has no mortgage, and we've got an LVR of 50% over the 2 Hamilton properties. And we've got cash because we've been saving really hard, trying to work out what to do next.
And you got your deposit back from a new build.
Yeah. So we're at my stuck thing really is what looking for, because of our ages, we're early 50s, nearly mid 50s, wanting to generate property that is going to maybe within the next, say, 7 years, by the time we're 60, generate really good cash flow to retire early, and wisely use the resources that we've got. And looking at where we are in the market, I can't find what I need in terms of getting an 8% yield. So I am looking for that cash flow yield. And I think it's interesting in Christchurch, thinking about, well, what if I was to move out of Christchurch and not actually invest in Christchurch? Like, okay, well, shall I look at Dunedin? So I've got kind of stuck with looking at other regions and other areas. Do I want another property in the North Island? Yeah, I'm just vacillating all over the place. Yeah.
Well, I'm from Christchurch too, so yay.
Yay, Christchurch.
It sounds like you're in a good position, Rebecca. So well done for doing that, over a period of time. It's a great achievement. And you've got 2 good cash flow properties in Hamilton, and Hamilton's just continuing to go from strength to strength as well. So with low LVR, so the banks love you at the moment, I suspect, and they want to throw more money your way. And you're happy, we gratefully receive that. Just want to know where to put it.
Yeah.
Okay. Where do you think the growth areas are in New Zealand, based on economics, based on job prospects?
Probably Christchurch.
I would think so too, actually. Hence I asked the question.
Yeah, and as I said earlier, I got myself psyched up, around the Verve, and we're like, right, we're going to do it. We're going to make a start here in Christchurch. So, but that's good. We've kind of done the hard work around getting over the emotional, mental hurdle of investing here after everything we've been through. And yeah, I look at the city and I'm like, it's amazing. It's going to be amazing.
I think you raised a point before, actually, about was the Verve an apartment building, or was it apartments versus good old standalone homes?
Dual key cash flow.
Right.
Apartment.
Right. So okay, great. So you're thinking of cash flow and then going to a dual key was quite sound. Off the plan is a little riskier, but it was sound, because apartments certainly you would want to get if you were going to get cash flow from them, because as a general rule, they tend not to appreciate as much as standalone houses on their own piece of dirt. It's the dirt that generally goes up, really, not so much the house. So that strategy was quite good. Obviously, you got caught, and you got your money back, actually. So.
Yeah, it was. Yeah, it was been fine. It's Probably the dual key really appealed in the city too, because we actually thought we might go and live in the city for a couple of years ourselves and just manage the studio apartment on Airbnb ourselves for a couple of years.
There's it depends what you're trying to do. When I say that, I mean, are you after really just cash flow strategies, or are you still after some capital growth? Because there's various strategies you can apply.
Not cash flow at the expense of some perceived capital growth, but just very aware of not wanting to make any decisions looking for and expecting capital growth. No,
which is you call speculating for one.
Yeah.
Yep. Well, I do agree that I think Christchurch has got, obviously it's going through a bit of a tougher time now, which is in line with what's happening in other parts of the world, actually. Sydney's and UK. So, I mean, I do see Christchurch as a good prospect going forward as well, given that's going to be a nice modern city and with heaps of growth and job prospects. So buying in Christchurch and in your own home territory is probably not a bad option, and looking for a property again where you can add value to because you're there, to increase the yield, therefore increasing the, you wouldn't actually, given your situation, you could buy a property, a standard property, let's call it, you buy a 2-bedroom property for whatever, you turn it into a 3-bedroom property and it costs you 50, 70, 80,000 to do that, rather than the traditional, well, let's go back to the bank and refinance that to pull that money out to go do it again. You could just leave that in there because you've got that capability to do that. Your yields would be great, we're giving you cash flow, and you're building up that equity, for down the track in a few years. So, I think, I know Maxine's a property finder in Christchurch. She's pretty good, actually, and she's a good investor. She knows the market down there as well. Probably wouldn't hurt to have a chat to her, I think, or find it yourself, obviously. That's the best thing, if you've got the time. But, sorry, Nick, I'm not meant to say that. But certainly finding a house a property you can add value to. Again, I don't know the sweet spot. I love universities. I invest around there. I used to have one in near Canterbury University, a little 8-bedroom one. Sold that, but that's the market I love and I'm into, but it might not be you. But certainly something you can add value to. Buying it, a bit like we're talking about before, it's distressed, or you're the one creating the equity and getting a decent yield out of it. And in Christchurch, I think you really, again, you'd want over 8%, really over, at a minimum, at a squeeze. And that's gross yield. I mean, I like to think of net yields, and everyone's different because rates and insurance is different, of course. And we are seeing a changing landscape in the insurance market too, if you're not aware of it. We are certainly in Wellington, we've got companies pulling out, but well, discouraging people to invest, insure with them. Let's put it that way. But they're starting to do a risk based on your house and the area. And so if you're in a flood prone area, earthquake prone area, then your premiums will go up accordingly. It's something to be aware of. I know it's funny, and I was talking to someone about this the other day when I started investing in property in 1999 AD. We never even thought about insurance. Like, oh, you'll get that the day before we said it. So it was fait accompli. Now I know on a due diligence, insurance is the very first thing I look at. I don't look at finances or anything. Can I get insurance? I mean, that's Wellington specifically, but it has changed. The market has seriously changed in that avenue. So, and Christchurch will be just the same. I'd suggest.
So, what's it a net yield?
Well,
in general, like to be
I think the answer to that, you have to decide what you want as a net yield. But what you'd be looking for would be, you'd be thinking about what the delta is between the net yield and the cost of money. So if interest rates are 4.7, do you want 1% above that, or 1.5% above that, or 2% above that from a net yield perspective? Because that's your profit. That's your cash flow above that.
Right, yeah, of course.
Isn't it? So it boils down to that. Yeah. And you can play your own rules. Everyone's different. Different has a different risk factor. But don't forget, it's not what you're buying, it's what you're creating.
Right. I think that's the part that I've got stuck.
Right.
Yep.
Have a chat to Maxie.
Yeah, I think I will. Okay, that's really encouraging. Thank you.
Yeah, bang on. I think you can create cash flow. There's plenty of ways to create cash flow. I'm like Peter at the moment. I invest around inner city, and it's buying bigger houses and remodeling it. And by saying I do this, I mean I call the builder, I call the valuer, I call the architect, I call my banker, I call my property manager, and then I call them again and say, have you done this stuff yet? And then I pester them throughout the project. So there's a bit about just working out what is possible and what it can be worth, and then just working with your team. And I know this video isn't supposed to be an iFindProperty promotion, but that part of what we bring to the table is we bring the team to the table to do this. And because of your position, what Peter said, you've got capital to play with. You can manipulate your cash flow in a way that the servicing is never really an issue. And I think Christchurch is due, as the jobs come in, the rental yields are going to get a bump because rents are going to increase. It's too low for the second equal biggest city in New Zealand right now. So I think even though this isn't in the property handbook, so to speak, you always look at the numbers you get straight off the bat. Positioning yourself in those good markets and getting a reasonable cash flow and getting a high quality property, you're just going to do really well over time. I mean, Wellington at the moment is going through a rent crunch, and for the last 3 years, I think, after having done nothing for a few years, the last 3 years, it's been like 5 to 10%, like bang, bang, bang. And when that's happening, your mortgage is flat. So you're just sitting there going, oh, this is gravy. So now's the time to sort of position yourself for where that's going to come.
Good job. I've done some work on my fear and investing here then, isn't it?
Yeah, agree.
Yeah, okay. No, that's great. Thank you.
No problem, Rebecca. Okay. Lisa, you've been waiting really patiently.
Yeah.
Hello. That's all right. I was last, so I'm happy to go last. So my situation's a little bit different to everyone else, although bits of what other people have said, but yeah, a bit different. So I've got 4 properties, 3 are in Auckland, 1's in Mangawai. I've had 3 of them for a long time. So the Mangawai and 2 of the Auckland ones are pretty almost $5,000 off mortgage free. And I bought a home and income, a 5-bedroom and a 3-bedroom, 2016, which was quite a big a big amount from the bank. So that was a bit of a I'd been sort of sitting waiting for a number of years to do that, and finally took this step. But sort of where I'm at is, so I mentioned before, and just you were mentioning about the insurance, and that one got stuck in that big, New Lynn flood thing. It wasn't in New Lynn, but yeah, the same day, it's in West Auckland, and it got hit by that, and then the following year it got hit again, and I've just kind of got to the point where I'm emotionally like, I feel like I need to get rid of it. I don't want it anymore because it's caused so much drama, and because I've got 3 kids, I'm pretty much doing, like, my partner's not really interested in property at all, so I feel like I'm doing this on my own. I've got no time to like do any, I don't know how to do any renovations, and even if I did, I've got no time. I've got the kids with me. I work part-time, but like 3 days a week, but yeah, so that's bringing in a reasonable, income, but I guess my goals are that I'd like to keep spending time with them, and yeah, more time as they get older. So I guess in the next 10 years, done and dusted, as one of the other guys said, if 10 to 15 years done and dusted, and sort of having that income coming in, and I'm kind of thinking, well, is this, is it gonna, the traditional thing is sell in summer. I mean, I bought, it seems to be, no one really sells in winter unless they have to, and it just looks a whole lot better in summer. Everyone's in a better mood. So is it going to be wise to sell, or shall I try and hang in there with that one? What one of the other properties is, it's just a old 2-bedroom that really I should get rid of that, I'm thinking, and just try and get consent to build 3 townhouses. That would take, all the money of that one, but I've got a reasonable cash flow coming in from the others to help and pay for the kids, and this kind
I like the last strategy. I'm not so sure about selling. I have to say I don't agree with you about selling in the summer.
Okay.
This is the winter.
Okay.
You go through stats, you actually get better prices in the winter.
Do you?
Yeah.
Okay.
I don't know. Everybody thinks that. It's just, yeah, so it must be real.
Okay.
But it sounds like you're a little bit emotionally tied with the home and income.
Yeah, I am. It's taken a lot of time for me, trying, like it happened in March. I mean, I'm still, the tradespeople are coming in, still just finishing off, and the tenants are not happy because it's taken so long. They've moved out, and the insurance just, they're like, well, we've had millions of, hundreds of other claims. So, you're just one of many. You have to go through them. We can't get your own tradespeople. They try and pay you out, and I can't pay
So
people.
is insurance paying for the rectifying the issue?
Yeah, they are, but their premiums, like you were saying, have gone skyrocketing. It's now it's gone from like just over 1,100 to like 3,000 a year. So rapidly the costs, and I've spent all this money on drainage, but it's never 100% guaranteed. So I'm just feeling like,
I don't think you can, if you did want to sell, I don't think you can sell something until it's fixed to get the best price, to be honest.
yeah.
So I think you need to carry it through. But what sort of yield are you getting from it? Is it cash flow positive property for you, or is it?
No, it's not.
It's not.
It's not. No, but none of mine in Auckland have been.
Right.
Except the one that I bought like 20 years, when I was
Right.
out of
So
school.
the other properties you've got, you said there's a 2-bedroom on this, and you could redevelop it and make.
Yeah.
Well, that sounds pretty exciting.
Yeah, it does. I'd have to be pretty, it's the same thing. It'll take a lot of time, and I'm a bit unsure about how to go about it. Like,
okay. When you redevelop this piece of dirt, is it something you would do as a buy and hold, or would you trade?
Yeah, I would hold that one.
Trade.
Yeah, definitely. Yeah.
So you'd be looking at least, you'd want a 10% yield if you can get it.
Yeah, and it would be, because I mean that one's pretty much paid off, so anything is just.
Well, you're actually pretty simple, Lisa. That's the focus. I mean, you own the dirt, no one can take it from you, and you've got a 10% gold mine or more under your feet.
Yeah. It's just this other one that's kind of like killing me. Like, it's just
Well, if you leverage that to build the other ones, that's an option.
Yeah.
One option.
Yeah.
Obviously, my preferred option is always about revaluing it.
Yeah.
To build the other one, but
I don't know if it would. Yeah. Because I only bought it 2 years ago, and I don't.
Negative. Yeah, I know if it's not making any money, then
I don't think it's gonna.
Because you want to be, you don't want to be without property now. You need to have property, I think.
Yeah.
So developing the other one is going to give you 3 or whatever it is, 4 houses as it becomes trend.
Hopefully 3.
With it, if you get a greater than 10% yield, you refinance that. You're off the races again, aren't you? You can go buy somewhere else.
Yeah.
And in the meantime, you're stopping the rot from the other one. But I would probably think that I would fix up all the problems.
Well, I've fixed them as much as we can, but it's never guaranteed. It's a sub basement. You know what I mean? Like it's the ground level is 2 bedrooms, basically underground level. There's a little window, but it's just those one-off events that happen once a year, and it's just you sit there every time it's a heavy rain, thinking God, and it's just it's
those 100-year storms that happen every year.
That's right, and it's just happening more and more, and I just think, God, I've never sold anything, so I don't know, even where to start, and I
start with iFindProperty.
They'll get rid of it for me.
They'll get rid of it for you, a fellow investor. But I'm not a big fan of selling unless you've got a reason. I mean, I've sold, as I've said, and certainly helping Nick, and he sold some of his as well to go to bigger and brighter things to help accelerate the end goal, or whatever the terminology was before I'm out of here or whatever. That accelerates it. So doing that will accelerate your end goal potentially, but don't be without property.
No. Okay.
Lisa, I've got an idea for you. So something I'm doing with another investor in Auckland is helping them buy a property, and then we have a consulting partner who's coming in and doing analysis on the sites, and they're buying it with the intent of basically putting it through a resource consent and building it. You can actually get construction lending to fund the entire project based on the future value of what it's going to be.
Okay.
So it's going to be worth $2 million. The current land is worth, let's say, $1 million. It's going to cost X to do it, or $3 million it's going to be. And they'll just look at end value, LTRs, cash flow, etc., based on a registered valuation.
Absolutely right. Yes, you're 100% right. Which bank are you with at the moment?
ASB.
Perfect. Perfect bank for doing this. I'm doing exactly the same thing. They're going to fund.
So am I.
100% of the new build.
Okay. That sounds good.
I've just had the bank fund their second straight renovation for me, both 6 figures, and I'm about to roll back in there with a third next week. And they like new build. New builds are easier because they're more concrete and everything's new and it's known. Once you've got a geotech report, there's not a lot of maybe.
It takes time to get there though, because you need fixed price contracts and all that. I mean, there's a lot of work up front, to get it over the line. But it's worth it.
I mean, and that's sort of part of my situation is that I don't have a lot of time, and I don't have really anyone else to sort of help me along the way.
Welcome to iFindProperty. We can take care. No, I wouldn't even be me. I've got a colleague who does this. He sits down with people, does an examines the land, helps put together consent documents, and puts the consent application into council for you, and you just approve of it. I mean, it sounds flippant. It's not that easy. Obviously, you're going to have to sit down and look at the houses and go, I want that one over there, or change it. But he does all the driveway turning analysis and the survey analysis, and anyway, So what I'm saying is you can outsource all this.
Yeah.
You pay them a fee to do it, and then you pay some money to put in the council submission, and then that takes months.
Yeah.
So this is not something that you then have to
No.
be moving and giving up your time. That takes a long time. But once that comes out, your land is now worth more because it's consented to develop. And based on that, you can start talking to valuers and builders about the next phase, which again takes bloody ages. But again, you outsource the bits and pieces again, and you just focus on getting yourself to that sort of next stage.
Yeah, yeah. But do you think I should try and hold on to the other one, even though I'm just hating it? Like, I know it's all about buy and hold, but when you just, is it a bad time in the market to be selling? I guess is what I'm asking. Like,
I can't answer that. I don't know the house.
But
I think I'd agree with Pete. Is that fix all the problems? That's the first thing. Because if you sell a house with problems, okay.
So,
Look, we could appraise it for you. Get an appraisal.
Yeah. Yeah.
I'd be talking to your bank to make sure you could buy again if you were to sell.
Yep. Yeah.
Make sure you're not, because if the lending criteria has changed and you wouldn't be able to buy again, then I'd be looking at strategies to hold it. But if you've got flexible options and you could move that money into something more interesting, and this is giving you nightmares, then don't underestimate the power of being able to sleep at night. Something always.
Yeah, it's just because I've got all these little ones to think about, and I just don't need the extra worry. Even if it is fine, I've kind of done my dash with it now.
Yeah, so I think, from a priority perspective, I would be going down the avenue of developing first.
Yeah, okay.
Not touching your...
Just leave it. Hope for the best.
Distressed one. No, there's no hope. There's no hope. No, there's no hope. Was it Yoda? Do or do not. Do not try. Know the outcome. Just know the outcome, what you're trying to get, right? And just go for it.
Okay. Cool.
Speculation is not something, we like to think of too much.
Yeah.
So anyway, I mean, we all hope property prices double, but
and they do.
Not really about that though. Yeah.
No, it's not. So if ASB will fund 100% of the build without you touching the other property, then it's a conversation we have again.
Yeah. Okay.
But your your get rich quick scheme, should we say, which doesn't exist, will be around developing the land, I would imagine.
Yeah. I mean, I'd rather not have both huge debts on the go at once, given how long it can take to build and stuff, and just given I've got 3 dependents and stuff. That's a bit, doesn't make me feel that comfortable.
Right.
So
it is a number, and with the thing with construction lending is they understand that it's going to be a lot of debt, so they actually will put the interest on that as you go through it. So I mean, I think you've got a few conversations ahead of you with some people before you and just work out all your options. Yeah. And then the decisions will be a lot more clear than I think now, because you've got a lot of in your head and you haven't really explored that enough.
Yeah. Okay. Cool. Thank you.
So I'll fire you over an introduction after probably tomorrow.
Thank you.
And we do have one more on the call. It's been dark. Dixon, you signed in late. Are you still there?
Still here.
Oh, hi. Oh, I can see that.
Can you hear me?
We can, but you need the video on.
Oh, it's a bit not convenient.
Oh, it's not convenient. Okay, you can. We'll watch the talking screen then.
Yeah. Okay. I'll just go through this quite quickly. Basically, I am 30 years old, and I have 3 properties. One in Rotorua, one in Auckland. That used to be my PPOR, and the third one is now my PPOR, which I have with my wife. So the one in Auckland is now an investment, and we are thinking a lot about moving into getting into the do-up scene, and just sort of, not knowing where to sort of start, really.
So you're talking about getting into the trading.
Correct.
You would be wise to talk to a good accountant to understand that what structure you're going to do for your trading doesn't jeopardize your existing buy and holds, or,
Yep.
or the
All
risks around
all
that?
the existing buy and holds are all in separate LTCs already.
Right. I think it's still worth the conversation.
Yep.
When you say get into the scene, you haven't done a trade before, but you like the idea of going out buying properties, adding value, and selling them. Is that what I'm hearing?
Yeah, with the aim of buying into, building up funds to get a good buy and hold.
Right. Okay, that makes sense. Where do you live? Are you in Auckland?
I live in Central Auckland.
Central Auckland. Okay. There are a number of people that do that in Auckland, actually, I know of.
Yeah.
Full-time traders. Also, again, I'll plug iFind because it's Nick's business, but as property finders, they can certainly help you find a property for a trade. Depending on, where obviously you need to think about your budget. From a trading perspective, I guess what's important is understanding the outcomes before you buy the property. So you really need to go into a property knowing or having a very good idea about what the after repair value will be. Like how much will it sell for easily, as it were, not without getting the top dollar.
Yep.
That's a bonus, but what's a nice safe number to use as a selling price. And then you want to look at what you want to do to the property to get that price, and then the cost to do that. So once you've got the cost worked out, and you know what you think the selling price will be, because you've used professionals here, like a valuer or a real estate agent, not the selling agent, of course, but a real estate agent to give you an idea of the values.
Yeah.
Then from there you can work out how much the house is worth to you to pay for, because there's, obviously your profits in there as well, and your tax. And if you're a trader, you'll be paying GST as well. So about 48% of your profits will go in tax and GST. And then it's a matter of building up, and it does take a while. It's about building up the team around you, like having good builders and electricians and plumbers and painters and plasterers and landscapers that you can call on as part of what we would term as part of your team to go and do the job quickly, because time is money, right?
Yeah.
And then if you're going to do anything, with regards to water tightness or structure, you're going to need a building consent. And I don't know about Auckland, but if it's anything like Wellington, that's not a fast process or a cheap process. So time is your enemy, obviously, when you're doing trading in a flat market. Time is your friend, obviously, in the last 5 years. As the longer you've taken to do a trade, the more money you've made, because the market keeps going up. But I think we're probably not seeing that so much in Auckland anymore. So again, it's being well educated in the numbers and having your team around you, Dixon. There's no easy formula here. It's doing all of the above, and being able to probably be in a position to be cash unconditional to get the deal. Cash is king, and in a competitive market, someone with a cash unconditional offer is probably worth $10,000 to $20,000 more than someone who has got conditions on their property. So being cash unconditional is the place to be, but knowing your numbers about what the house is worth to you is really important. And if you're going to an auction, write the number on your hand and don't go over it. That would be my advice.
Yeah, the problem that we sort of face is also from a bank lending perspective. So,
yes, banks aren't big fans of traders.
Yeah.
And you might get the first one over the line, but they probably won't lend you the second one, because they don't make any money off you. Believe it or not, they don't make money off traders. So, if you're short of money, then you've got the choice of going to a second-tier lender, short-term money for a higher interest rate, or getting a JV partner, as we were talking about earlier, one who's got money. But then you're splitting the profits, of course.
Yeah.
But there are specialist lenders out there that are quite happy lending to traders if the deal's right. But tier one banks are not going to be your friend in the space.
Got it. So and also like just another question if I can. One of the investments I have, it has sort of leaky features.
Leaky features.
Yeah. Well,
I haven't heard it referred to as features, but okay, yeah.
Yeah, it's not like certified leaky, but it has certain traits that makes it leaky.
Yeah.
And so far we don't have any problems. There were sort of tests that were done before I bought it. So then the question is, this property is sort of good investment in Auckland because it's not cash flow negative, it's cash flow neutral, more or less.
Yeah.
It's just a question of, is it advisable to sort of sell and, in this market, especially when it's flat and look to.
So, well, as you probably heard before, we're not huge fans of selling, unless we really need the money to accelerate our wealth in other areas. The question I would have is that, is anything on the limb with regards to the leakiness or the weather tightness?
Nope.
Nothing. Okay. So then it's not registered as a
leaky home,
which is great. So you want to, for your own peace of mind and for future owners, you'd certainly want to rectify all those issues now. It only gets worse if you don't deal with it. So dealing with that now is good. If it's cash flow neutral, that's pretty good for Auckland. From my understanding, I'd be wanting to keep it if I can.
Yeah, it's actually in the location like I think Lisa, Newland.
Oh, Newland, right? It's a good area, isn't it? I mean, I'm living in Wellington.
Pretty convenient and everything. So yeah.
Yeah. I'd keep it if I can.
Okay.
Can you address the aspects of it, well, the features that have leaky potentiality? I don't even know.
It's a bit of a strange one because the house itself is made of two different cladding. One part of it is cedar, the other part is plaster. It's in an era whereby those guys thought that it was a good idea to sort of, for design purposes, have two separate cladding. And the plaster side of it's only half of the front. So I was thinking you could probably get away with targeted sort of reclads if it ever comes down to it.
Yeah, so it was built in the 90s, Dixon.
Yeah, the 90s, early 90s, I think.
Yeah, so it's probably that horrible hardy stuff, monolithic cladding, directly fixed to untreated timber. And the real issue there was, we've got Simon on the line. That's great. There's no cavity behind the cladding. So the cedar's probably directly fixed too, unfortunately, but hopefully not. But water's always going to get in, but the problem is it was trapped and couldn't get out. So a reclad really will is the only real way of finding out how bad the framing is, I guess, and putting a cavity system in behind there. But Simon's the expert on the line. He's best to answer that.
Yeah, I was about to say, if you are going to reclad, that's actually, you'll need a consent to do that.
Yeah.
So that's something to think about because that'll add extra cost to it. Yeah, it's not just as simple as just ripping it off and chucking something new on. It's yeah.
No, actually, on that point, Simon, you can all Google what's called Schedule A of the Building Act, and that will give you a list of everything that you can do on your house that doesn't need a building consent. It's written in good English, so it's easy to understand. Bullet points. So we quite often get a question about, do I need a building consent? The general rule is that if it's anything to do with weather tightness or bracing of structure, the answer is yes. But have a look at Schedule A, and that'll help you work out whether you need to get a building consent or not.
Cool. And is there any timing to sort of like, from a builder's perspective, to get started on a reclad, or is it advisable to sort of wait?
Any timing?
Yeah, like, is it, because right now I don't see any sort of obvious signs that it's rotting.
Oh, that it's leaking.
Correct. My understanding was just from at least from the previous owner that you just need to sort of paint it. The painting of the exterior painting is very important.
Yeah, so plaster finish, the weather tightness relies on the paint job. So, and the fact that there's no cracks. So if there's cracks in it, you need to seal them. And it needs to be have a good paint finish. In terms of the timing thing, I think the best way to ascertain that would be to get a building inspection if you haven't already done one. and they'll tell you if there's like moisture readings on the inside or anything like that. And if there is, then yeah, there's your timing, because you'd probably want to get it fixed.
Yeah, it doesn't go away.
It only gets worse.
Okay.
And then it becomes a health issue. And it goes on the limb as well. And once it gets on the limb, then you've got some real problems selling the house down the track.
Cool. But it's all freehold anyway, so I can do it any time I want. So.
Oh, sure. Yeah.
But cool.
Dixon, I have an idea for you just on the trading side of things. Pete sort of mentioned it right at the start. There are groups, there's plenty of them in Auckland who do it, and they coach and teach. There used to be a company that I wasn't a big fan of, just their marketing in general, called Property Tutors, which is no longer around. However, there's a lot of guys who are now sort of independent coaches. Peter knows a few, I know a few, but don't underestimate for the first deal having someone take you under their wing. Seeing how they analyze, seeing how they call the tradies, watching how they project manage, just basically call it, you're going to have to give up half the profits, but it's better than giving up all of the loss from getting one thing wrong that you don't know what you don't know, sort of thing.
Yep.
I'm a big fan of paying for coaching and mentoring when you're entering into highly leveraged deals with a lot of risk. And if you're doing, there's not a lot of risk for the really good traders because they know their market, they know what they can sell, and they know how to run a project. The risk for you is more the fact that you're doing this for the first time.
Cool. All right, I'll try to get in touch with you to get the names of those coaches then.
Yeah, no worries. Just get in touch. I'll probably get Pete's contact since he's been more involved.
Yeah, that's fine. That's no problem.
Pete, are you based in Auckland?
No, down the line in Wellington.
Oh, okay. Maybe I'll catch up with you when I get to Wellington.
Oh, yep, absolutely. Yeah, I'm here. Actually, I'm 20 minutes north of Wellington. I'm in Plymouth. Much nicer.
Cool. Thanks, guys.
All right, team. That's it. So, any last questions or comments?
Yeah, comments, any feedback or any questions you have?
Feedback.
Just from my perspective, there's been talk about joint ventures around on this forum. I have been thinking about that. However, my strategy is buy and hold. So I'm not, like you said, it's probably not the best for that. Can you just explain briefly, if you could, like how joint ventures kind of work, I guess?
Yeah, it's they are good if they're done well. It's like anything, and you're right. I'm not saying don't do them, but I'm not a fan of doing a joint venture that doesn't have a finite end. So buy and hold would be an example of somewhere I wouldn't do a joint venture with, but I would do a joint venture, and I have done joint ventures in lease options, which have a finite end, commercial property, and trading. Each property I run, I have a separate joint venture agreement, and it really details, generally it's only one other person, you can do more. It generally details what the project's doing and what are the exit strategies. What are we trying to do? What's our backup? And a few of the what if scenarios. I'm not a big fan on what ifs, but it's good to know, like, if we're going to have a divorce, how's it going to happen? If you want out before the project, then this is how we value your share, or whatever you come up with. There really is no prescribed formula. It's like you come up with, and you have it in writing. So if it does come to that, then it's in writing, and you can go disputes and mediation and all that stuff, and it's fair and amicable. I wouldn't, again, friends and family, not so much. With people in the industry, yes.
Is there any, like, a burning question for me is, because I'm a buy and hold, I don't really want to get tainted by doing trades, but that is one option, would be to buy a section or piece of land with someone, like a property. I could manage the project and potentially add another unit to it, but is there a way that I can not get tainted by like not having?
Let me jump in on this one, because I talk to my accountant a lot about it. And I think it's an article we've got. So the way the associated party rule works, so I think we've talked about trading with a few people, is any person involved in the deal, the IRD now looks through the entities, because it used to be you could have a trading trust and a regular trust, and that's how people did it. It looks through all that to this point where I've heard of a group of people who own shares in a syndicate all got stung for income tax because the IRD looked through and saw that one of them was doing building activities somewhere else. Right. So that's how far they'll look into this. But what all of the accountants I've talked to about this have said is what you do is when you're going to do your trading activities, you stop buying properties to hold, you set up your entity to do the trade, you set up the joint venture, you do the deal or deals, then you sell the properties down, then you shut down that entity, then you have it in writing, we've finished, like an email to your accountant or something, and then you go back and you do it. Because what they look at is they're looking at that timeline.
Yeah.
So it's properties that you buy while you're trading that become tainted.
Yeah.
And then you've got to hold them for 10 years to avoid the capital gains tax. If you, before or after, you're okay, as long as you clearly delineate when you're doing stuff. So it's not like a permanent tint.
Okay.
No, you're right, Nick. The key thing is at the moment is it's not even a 10-year rule. People think it's a 10-year rule. It's not. It's a guideline. The point is, if you buy a property with the intention of selling it, then it's a trade, and you pay.
It's a trade forever.
Forever. That's right. So one of the things that I also teach is that every time you buy a property, buy and hold, you write an email to anyone who will listen, Jacinda Ardern if you like, but your lawyer, your mortgage broker, your accountant. I buy this property because I'm keeping it as a long-term buy and hold for my future. And if the IRD come knocking on your door, it's up to you to prove that it was that it was a long-term investment, and then you've got the email trail to prove that that's what your intention was when you purchased it. But Nick is right, it's a 10-year guideline. If you buy a property and develop it for rent, then you're not tainted, of course, because rental is residential rental property is exempt. So you're fine, but if you have a habit or you're consistently trading, buying, selling property, then you'll become a trader, deemed to be a trader. It doesn't actually matter what's on the, that's the other thing that's worth noting too about the sale and purchase agreement. The GST is extremely important clause on the sale and purchase agreement. And at the end of the day, it doesn't actually matter what you say on that. It's how the IRD deem you to be. So I've always suggest a couple of clauses to add to sale and purchase agreements to protect yourself.
I know about that.
Sorry?
I know about that. I've had the IRD change the ruling on a person who sold the property to me.
There you go. There's a live example. Yep. Because it's how it's been deemed. So you got to be a little bit, well, you do. You have to be very careful. It can cost you a lot of money. So, it's just getting good advice from professionals, really. But you can avoid it. I mean, I trade, and I bought a buy and hold January this year. That's actually my last trade in January too. But separate entities I guess different emails, and I intend just to hold them over 10 years anyway. Buy and holds, I'm going to be selling them in 10 years. So it doesn't matter. Doesn't matter.
Yeah, there's a clear delineation between the properties you buy to trade and then wind up holding. That's always a trade. And then the properties you buy to hold while you're doing other taxable supply activities. Those are the ones that are liable to be tainted. But then that's the 10-year guideline. So that's a clear differentiation. It's all about your intent at the time of purchase.
Yeah. On a related subject, which happened to me, so I might as well mention it while we've got any time left. When someone asks you will you become a trustee in my trust, for instance, I get asked that a wee bit, family or friends or whatever, think about whether you will or not, because if you're a trader, you will actually taint them if they buy and sell property, and the other trustees by association. So I'm not saying don't become a trustee. You know, if you're responsible and you're willing to take it on, then do so. But by association, you could be tainting someone inadvertently, and that wouldn't be good for your friends and family relationship. So just be wary of that.
And that's about where we got to. Wow, almost 2 hours. So big thanks to everyone who was on the call. Special thanks to Peter Ambrose. He is a coach. He was my coach. So I read his advice. I did very well from it. If you're interested in talking to Pete more about perhaps working with him one-on-one, www.ambrose.co.nz. I can't rate him highly enough. Our website's www.iFindProperty with an I, just like iMac.co.nz. We're a licensed buyers agency for investors. We went over a ton on this call. We mostly around strategies, doing something different to create a different result was generally the theme that came through. Folks are either locked on servicing, locked around equity, quit their job, locked on both perhaps, or have done really well up to a point like Rebecca has with really good equity in good areas, but now has a different goal, wants to create some cash flow. So I hope you got something out of this. I think the people who were on the call certainly did, and we look forward to recording more of these in the future. Hope you enjoyed it.